Hello, everyone, and welcome to the Sustainable Finance Podcast. My name is Paul Ellis, and I'm your host for these programs about developments in this fast-growing industry. The Climate Earth digital twin platform was built by Riskthinking.AI, a climate risk data and technology company founded by Dr. Ron Dembo to model the financial impacts of climate risks. This platform is the only truly stochastic or randomly determined solution available for measuring climate financial risk worldwide and into the future. Previously, Dr. Dembo founded Algorithmics Inc., which he grew from a startup to the largest supplier of enterprise financial risk systems, serving 80% of the world's largest banks and insurers. Dr. Dembo has received many awards for his research in risk management, optimization, and climate change. And in 2007, he was named the Lifetime Fellow of the Fields Institute of Mathematics. Hello, Ron, and welcome to the Sustainable Finance Podcast.
Hello, Paul, and thank you so much for this invitation.
Yes, we're very excited about this conversation today, and we're going to jump right into the questions because I'm sure you have a lot to tell our followers. Let's just start with the whole idea behind risk thinking, and that is that you're really looking into the future, but it seems important to you that people understand that this isn't a forecast or a prediction that you're talking about. So, Ron, what is it?
Well, let me give you a quick example. Imagine you were talking to 1,000 different scientists, and they all have good models. They work in very good institutions. They have the best physicists working for them. Each model, there's about 85 institutions that are top-notch. Each model gives you some idea of the future.
Okay.
But they're not all the same. They don't have the same physics. There's some assumptions that are different. There's some experiments that are done with them. So you have 1,000 different answers if you look at 1,000 different people.
Okay.
What do you do with that? Is it nonsense, or can you do something with it? And that gets at the heart of what is data on the future. Data on the future is what's in our heads, what's in our scientists' heads, what's in our policymakers' heads, and to some degrees it's self-fulfilling, and to some degree it's actually just another forecast. So that's where future data comes from. It comes from, our clever brains as humans about understanding what possibilities could occur. Of course, we are just human, so we might miss some things. But on the other hand, any single one of those scientists is bound to be wrong. Or any single model doing a single prediction is bound to be wrong. It's almost like throwing a dart at Mars and saying, I want to hit that rock over there. You see the one on the photo? And, a lot of things can happen on the way to Mars.
Sure.
It's also like saying, I'm getting in a plane. I'm going to Paris today. And the pilot gets in and they've got a flight plan, and it's absolutely so-called deterministic. This is exactly the route you'll take. But he and I know that you cannot predict certain types of turbulence in the mid-Atlantic. And he or she will have to move around that turbulence. So at some points, it looks like he suddenly pointed the plane towards Iceland, and you say, wait a second, we're going to Paris. But the pilot knows it's Paris, but, doesn't want you to get thrown up and down. So the point is, there's radical uncertainty in a lot of what we do. And we try our best to have a flight plan, net zero, that sort of thing. But you cannot forecast certain things. There's no way. So when you do weather predictions, it's a similar thing. Weather models are very complex models involving a lot of physics. But there's uncertainty in that physics, uncertainty in the models. So what the weather people learned to do was to take an ensemble of models a collection of them, and in some way use them to create an aggregate view of the future. So that's where it starts, And so in the case of climate, there are tons of pathways, the IPCC, the international bodies, the NGFS, the bodies of the central banks have forecasts for the future. And it's like those 1,000 crazy scientists predicting points in the future. None of them will be correct. But that doesn't mean they're useless. They are very useful, actually. They all paint a picture of the future. So one of the things you can do about the future is get your hands around it as best as we can today with what we know today. And, in a month's time, it might change. In a month's time, we discover that under the ice in Antarctica, the water is above zero. And so that ice is going to melt faster than we thought it would.
Mm-hmm.
So that'll change our view of the future. It'll change scientists' view of the future. It might update some models. And so the very best we can do in a very uncertain world, think of just driving your car in a dark forest, very best we can do is plan for the next period. In your car, it's as far as your headlights can see. And you don't know until someone jumps into the headlights that you're going to hit them.
Right.
So what you do in that case, it's a great metaphor, because what you do is you drive a little slower. You drive to the point where your speed is enough to stop if something were to jump into your vision. But your vision is only so much. You can't see behind you, you can't see darkness in the woods and so on. So that metaphor is very common to us, yet when we look at climate change, and when banks look at climate change, and when consultants are looking at climate change, the best of all of them, we do something which I think is quite silly. What do we do? We take out a laser beam, i.e. a single scenario. It's a laser beam into the future. We see perfectly along that beam, but anything to the side of it, we don't see it. So, and we say, well, maybe we'll do a little better. We'll take 3 laser beams. So the Bank of England requires you to look at 3 different, I call them laser beams, because they are single pathways into the future. It's literally a forecast, which is a flight plan to Paris. And they might say, well, let's look at 3 flight plans. That's not enough. You need to be able to have all of that equipment on the plane that says, look, I can only see so far with my LiDAR, so I'm looking ahead to see if there's any real bad turbulence. And if I see it, I'm going to go around it. And that's how I manage that uncertainty. I don't believe that my flight plan is immutable. I believe that I need the flight plan plus a hedge. What's my hedge? A LiDAR beam that only sees a few kilometers ahead. And that is the metaphor we should have for climate change. All we can do now is do the best we can to get our hands around the future, to understand all of the possible pathways. But we're only going to take a decision for the next period. The next period might be till the next moose jumps into the headlights, or in other words, next scientist finds that the Antarctic is melting faster. So if you keep that metaphor in your head and apply it and use it to benchmark what is being done today by regulators, by consultants, your hair would fall out.
It's falling out anyway, Ron.
No, I understand I'm in the same boat, but basically the reality is, from a mathematician's point of view, what's going on in our climate finance today is outrageous, to put it mildly. It's just plain wrong. And it plain won't solve our problem, just like the single flight plan might get us in trouble.
Mm-hmm. So walk us through, and you've mentioned a couple of possibilities already. Walk us through some of the pain points people are struggling with when it comes to actually using climate data the correct way?
Well, really, we'll have to just divide this in two pieces. The first pain point, pretty much for anything, is you need to understand the physical nature of the being that you're looking at or the company you're looking at.
Okay.
Because without that, you can't calculate where the turbulence is or what the physical risk might be. So there's a big hole in our financial system today, which is pretty much any bank I've ever met does not have very good data on the physical nature of their counterparties. So in that sense, there's no way they can price loans properly, assuming that climate will hit that physical infrastructure, which it is doing. So that's a big, big pain point. Think of that as a whole. That's got less to do with the stochastic or deterministic. We'll talk about how you get there. But it's uncovering that because that data is not available anywhere. So how do you get that? We can talk about it if it interests you. The second problem is what we started with, which is how do I even represent climate future? So first of all, the way you represent a future number is as a distribution, a probability distribution. Because the best you can say is there's a 50% chance of weather being bad in the Rondex next week. So you need to understand what future data looks like. It looks like a distribution, doesn't look like a number. And so the second point is that in climate change, what's going to happen is geographically located and geographically important. The same two assets in two different geographic locations could have very different climate risks. So you need to know in every location where some company might have financial assets, physical assets, what all the hazards are in that location. And more than that, what possible transitions could occur in that location. So the hazards are sea level rise, cyclones, hot weather, and so on. The transition hazards are things like the price of electricity, the cost of carbon capture and storage, and things like that. These are macroeconomic, microeconomic variables. So they are all, by what we discussed earlier, distributions. But not only that, those distributions change with time. So you need to know for every location, for every possible hazard, for all possible time periods going forward, the distributions of those possible values for those hazards. Now that's a tall order.
Yeah, it is.
Yeah? That's exactly what we've built. But that is a digital twin of a future climate world. Because if someone told me, here's a digital twin of a future climate world and it has single deterministic equations, I would not believe it because there's no way you could make that single forecast. So the trick in building those distributions is taking into account every possible scientifically valid pathway going forward, which is a lot. We use about 1,000 pathways, somewhere between 500 and 1,000. They come from the IEA, they come from experiments or models. They're what's in our heads, so to speak, in the wisdom of our experts, an expert being a model even. So now the next question is, how do you even weight that to get the distribution? Because you've got all sorts of different numbers. Who do you give the biggest weight to? And therein lies something very, very interesting. Picture the election that's coming up now.
Okay.
There's a Trump world and there's a Harris world. Happen to be very different worlds. In a Trump world, you would imagine that if you drill, as we're being told, you will have a 4-degree world or higher. In a Harris world, if you're told that we're going to build a lot of infrastructure and mitigate risk and, be good boys and girls, you will get more to a 2-degree world. So the difference then is not to point and say, I'm going to look at a 2-degree world, a single scenario, and a 4-degree world single scenario, which is what Bank of England might do. But to say, I'm going to look at everything, but I'm going to weight the extremes in both cases very lightly, and I'm going to put the current consensus with the most weight. So think about distribution, and the most weight is where there's most height in that distribution.
Mm-hmm.
And that's where I'm going to put, that should be center for Trump, and go out to infinity and lightweight to the sides. And in a similar way, the distribution for Harris would be different. It would be centered around 2 degrees, but it would also include all possibilities with low probability. Why? Because in a normally functioning world, abnormal things occur. In a normally functioning human being, abnormal things occur. I might be paranoid for 3 seconds, but if I was paranoid all the time, I'm declared paranoid. But I'm not declared paranoid if I just have a paranoid outburst. Okay, see what I mean? So
Yes.
Normal is being not extreme all the time.
Okay.
So
I'm sorry, I'm going
Hurricane Milton every week, then we know we're in a 5-degree world.
Right. So, Ron, I'm going to jump in here, and I don't mean to interrupt you, but we've got a number of different kinds of pain points that we're talking about. And are there any signs here that the banks and the regulators or the insurance industry, the people who are supposed to be focusing on the control elements here, are they getting better at this type of analysis, or are they still functioning in the past?
So there's a good news, bad news story, okay? The good news is that people are now becoming aware that knowing the physical assets of counterparties is an essential ingredient. Tick that one off. It's still going to take a while. We've built a database like that. It happens to be probably the largest database of its kind. And, if you want it, please come and buy it. We sell it. And if you wanted flooding in Afghanistan in 2050, we can give it to you, and so on. But the future of a climate is where it goes awry. And the reason is that most of the people dealing with climate change in these institutions do not have the mathematical knowledge to understand how to deal with radical uncertainty.
Okay.
It's just simply not there. And it's like me trying to come and explain to you today about climate change and speaking ancient Italian.
Okay.
Whereas, you'd rather have it in English.
Mm-hmm.
So a lot of what we speak is ancient Italian when it comes to stochastic. And, now when we go to people who are mathematically inclined, or people who are in enterprise financial risk, this is motherhood. You wouldn't price an option by saying it's going to be 10 times the strike price.
Right.
You'd solve differential equations to get the option price. So that is a massive second hole. That's simply the knowledge you need to do this properly is just not there in the client base. And that's a challenge. It is in certain locations, but not all. Particularly, I'd say it's a very big challenge amongst regulators. Now, we have a very good relationship with the local regulators in Canada, and they understand it. And their challenge is just, what do? We can't impose regulations on people who don't understand what we're regulating. So they want to get there slowly.
Okay.
So I hope that explains what. And just to add to that, the insurance industry is completely rooted in actuarial analysis and CAT modeling.
Right.
That's all backward-looking data, pretty much. They're trying to now say, yes, we do need to go into climate. We'll probably need some stochastic data, but where do you get it? How do you do it? So they are realizing the need, but not having the technology.
Okay. So from your perspective today, will we ever get to a point where there's a real mark-to-market price that includes climate risk by default? And give us an example of what a mark-to-market price that includes climate risk would look like.
Okay, let me give you a real example, and one that's very relevant because it's the issue of how you price loans, for example.
Okay.
So you can imagine that all the loans in the world today are mispriced because you're not taking into account physical risk. So say you were to say, I'm going to give loans to every company in the S&P 500.
Mm-hmm.
These are big companies. They, probably got the wherewithal to pay back and so on. So I'm going to loan to them. That's my business.
Mm-hmm.
Now, guess how many physical assets you would need to know about to be able to do that properly.
For the S&P 500? Wow. It's a lot, I'm sure.
It's about 660,000 of those. But to be able to stress test those assets, you probably need 650 million multi-factor stress tests to understand what could happen to those assets and then to incorporate that in price. Now, let me take another step. When you price a loan in a bank today,
mm-hmm.
all sorts of stuff gets into it, none of which is modelable in a way. Did I play golf with Joe's wife last week?
Mm-hmm.
And she really wanted a special deal on the loan for, that kind of thing. So there are immutable numbers in the calculation of price. For example, what's the loan to value? The loan to value is how much am I borrowing against how much is my collateral. Now, my collateral might be my house or other buildings. But stuff could happen to my house from climate change, as we see in Florida.
Right.
So that collateral could go to zero. So if you have a good way of pricing the impact on that collateral, forget about pricing the loan, you have a good way of getting a climate mark-to-market for the loan to value.
Okay.
And to standardizing that. And then when you use that, you get actually, as part of your pricing, the answer to your question is absolutely yes. We can and will reach that. And we'll reach it with stochastic analysis. And it'll happen quite soon. We are doing that right now with regulators
mm-hmm.
and with potentially some banks.
Okay. Well, Ron, listen, keep up the good work, and hopefully this program will help some of the people that you're talking to about using your stochastic method engage with you in that process as well. But for the moment, where online can our followers of the Sustainable Finance podcast go to find out more about your work at Riskthinking.AI, and how can they get in touch with you to learn more about the topics that we've discussed in today's episode?
So there's one free resource that allows you to go into our digital twin and ask almost any question you like. It's called ask.riskthinking.ai.
Okay.
And you can say, for example, show me under a Trump regime, what would happen? What are the top 5 companies that will benefit from that or be hurt by that? So you can ask questions like that, or how does Microsoft compare to NVIDIA in 2050 for climate?
Mm-hmm.
Those are tough questions, and you'll get a stochastic answer. Now, the digital twin, we actually license pieces of it.
Okay.
So you can say, I want to get asset data on all my assets in Northern Europe.
Okay.
Associated with these companies. So you can ask that and get it. You can also say, I would like to have stochastic flooding data for the UK, but only from 2040 to 2060, and you can get it. So now, our website says something about this. It's never good enough. We write a lot on LinkedIn, and that's there's a lot of posts there. But there is a thing called climate at riskthinking.ai,
Okay.
which comes to me and to our experts, and we would be really happy to follow up and talk to you about any of this.
Great. And whatever you would like to have us attach to this program, we can do that. So please send us links for that process. And it sounds a little bit like we're getting on the Enterprise and about to start taking a journey at warp speed. So we'll look forward to you captaining that ship for us. And Ron, it's been a pleasure talking to you today. This is a really interesting conversation. I definitely want to continue it. And for our followers, my name is Paul Ellis, and this is the Sustainable Finance Podcast.